Good morning, Aisha.
Morning, ma'am.
How are you, dear?
I'm fine, ma'am. How are you?
I'm fine, thank you.
Good morning, ma'am.
Good morning, Rabia. How are you?
Fine, ma'am. How are you?
I'm fine, thank you. Good morning, Mariam. Good morning, Mariam.
Good morning, ma'am.
How are you, dear?
I'm fine, ma'am. What about you?
I'm fine, thank you. Mariam, whenever you get time, please try to attempt that mock which I had sent in the group. Okay? Today,
Okay, ma'am.
tomorrow, whenever you are feasible, when you are feasible with it.
Sure, ma'am. Sure.
Okay, students, yesterday Samiha had requested me to reduce the amount of the chapters for the test for financial accounting. So I had included 11 chapters for your test. Now we can reduce it to 9. 9 chapters are fine for you all?
Okay, ma'am.
Fine for everyone? Okay, so we are going to have a long test up to chapter number 9 for financial accounting in our upcoming lecture of F3, sorry, for F3, okay? Up to intangible assets. Excuse me. Okay, now students, without wasting any more time, as you do know that in our last lecture, we were having a look at IS 37. IS 37 is provisions, contingent liabilities, and assets. It tells us the details about any kinds of the obligations which the organization can have before to its year end. Up to its year end, whatever liabilities, whatever obligations are present with the organization, they have to be recognized in the statement of financial position. In our previous lecture, we had discussed about the definition of liabilities which had been provided to us by IS 37. IS 1 also defines assets and liabilities, but in IS 37, again, we do find the definition of liability. As per IS 37, what is a liability? Liability is any kind of obligation of an organization which is the result of a past event. And when we are going to fulfill that liability, it will result in the outflow of the economic resources from the organization. So whatever responsibilities or the obligations an organization is having at its year end have to be recognized in the statement of financial position. Why IS 37 tells us the definition of liability once again here in this standard? Because here the purpose is to make you clear about another kind of the liability which is known as a provision. A provision is a liability with an uncertain timing and an uncertain amount. Provision is such kind of a liability which also have to be recognized in the statement of financial position as per the prudence concept. Whenever we are recognizing provisions in our statement of financial position, it is in line with prudence concept. Prudence concept tells us that the organizations have to be careful while recording assets, liabilities, incomes, and expenses, so that incomes and assets should not be overstated and liabilities and expenses should not be understated. Any foreseeable losses or obligations have to be recorded, but not the foreseeable incomes or profits. So the definition of provision as per IS 37 is a liability with an uncertain timing and an amount. It means that a provision itself has to be cleared, has to be fulfilling all the characteristics of the liabilities. It is a present obligation which is arising due to the past event. Past event can be anything, a constructive obligation or the implied obligation on the part of an organization. It can be arising due to the any contracts which the organization has made with the other people or parties, or it should be arising because of the behavior of the organization. It is the past event. So obligation, liability is going to be arising due to the occurrence of any past event. It is going to be fulfilled in the case of provision as well. And when it is going to be fulfilled, it is a result in the outflow of the economic benefits from the organization. So provision itself is a liability. But there are certain criteria which have to be met in order to recognize the provision in your books of accounts. Because provisions is a sensitive area. It is an area of accounting in which so many directors do try to take an unfair advantage. Whenever they do want to show their lesser profits, they do increase the amount of provisions because they have not actually occurred up till now. It has to be occurring in the future. It is dependent upon the future events. So when they do want to decrease their profits, they increase the amount of provisions. When they do want to show higher profits, they decrease the provisions. That is why IS 37 tells us a proper criteria which has to be met in order to recognize the provisions in our books of accounts. In IS 37, we do learn about three things: provisions, contingent liabilities, and contingent assets. Only when the criteria which is provided by IS 37 is going to be fulfilled, provisions are going to be recognized in our statement of financial position. Contingent liabilities and contingent assets are not going to be recognized in our statement of financial position. This is the first thing which you have to keep in mind. In all these three things, if the criteria is fulfilled, only provisions are going to be recognized in our SOFP. It means that we are going to write them as the liability in our SOFP. And we are going to write them in our statement of profit or loss as well. Contingent liabilities and contingent assets do not become the part of the financial statements. Let's read from your book what your book says about provision. A provision is defined as a liability of uncertain timing or amount. It's a kind of a liability about which we are not sure that when it has to be fulfilled in the future. Time is uncertain for its fulfillment. And the amount which is going to be outflowed from the organization when we are going to fulfill it is also uncertain. We are not sure about that. When it is going to be materialized, how much amount is going to be outflowed. So it is a liability of uncertain timing and amount. For example, an entity may face a legal action for a breach of health and safety law. The likely repercussion is that it may be fined if the court judgment is made against them. The timing and severity of the fine will be decided by the court at some future date. The key question is, should the entity reflect this information in its financial statement? Say, for example, organization has breached some health and safety law, and the persons who have faced the consequences, they have sued the organization. They have brought a suit against the organization. Now, because of this case, the organization may suffer severe outcomes, severe consequences. But the organization is not sure that whether the court of law will be giving the decision in their favor or not. So the question over here arises that whether the organization must be recognizing the provision, this kind of liability in their books of accounts or not. So here the question regarding provisions arises. We are going to record the provisions in our books of accounts only if the certain criteria is going to be met. What is that criteria? We have to learn that. Here is the 3 points criteria which has to be met in order to recognize the provision in books of accounts. Recognizing the provision means that we are going to pass the accounting entry for that, and further we are going to record it in our financial statements. What is that 3 points criteria? First one, a provision shall be recognized when an entity has the present obligation, legal or constructive, as a result of the past event. This is the definition of liability. If it is a liability, then it has to be recognized. And what is a liability? A present obligation arising from the past events. And past event can be any legal one, that is due to any contract or agreement from the side of an organization, or constructive one, which is implied because organization's behavior has made the expectation in the minds of the others that the organization is liable to do these type of things. That is constructive obligation. So the first criteria is an entity must be having a present obligation which is arising from the past event. The second criteria, it is probable that the outflow of resources embodying economic benefits will be required to settle the obligation. Now, when it is going to be fulfilled, it will result in the outflow of the economic benefits. It's again what is being taught to us in the definition of liability. But the point, added point here in the definition of provision is this word probable. And you must be cleared that what is the meaning of probable. If you are going to see the dictionary meaning of probable, it means that whenever there are chances of something to happen, we do call it as a probable event. But here in accounting, they do provide you with the degree, with the percentage, which is going to show you that the certain event is probable. If the chances of anything to occur are more than 50%, we call it a probable event. So when the certain event which is in front of you, when it is going to occur, it will result in the outflow of the economic benefits, and the chances for that particular event to occur are more than 50%. You will be calling it a probable event. Is it what happened? You are going to call it as a probable event. So probable means when the chances of a certain event to occur are more than 50%. Okay, so you have to, whenever certain criteria will be in front of you, you have to see that what are the chances of that particular event to occur are there. More than 50%, it means the second criteria is also being met. Second criteria is, it is probable that an outflow of the resources embodying economic benefits will be required to settle the obligation. And the third one, a reliable estimate can be made of the amount of the obligation. This reliable estimate is the condition for everything. For IAS 16, for IAS 38, we have seen this condition, that we must be able to make a reliable estimate of the particular event, of the particular amount which is going to be outflowed. Reliable estimate can be made because of certain evidences which have been created. If there is no evidence, no reliable estimate could be made. If there is no market available for the particular thing which is going to be sold in the market or whatever is going to happen, there is no evidence. So a reliable estimate must be made. So 3 criteria: an entity has the present obligation arising from the past event. It is probable that the outflow of the economic benefits will be happening, and the reliable estimate could be made. So here in the provision, if the chances are more than 50% for the certain event to occur, we are going to recognize a certain event as our provision. When the chances of something, some liability to occur are more than 95%, it is virtually certain. It means that it is going to occur anyway. It is a simple liability. It has to be recognized in our statement of financial position. When uncertain timing and amount is involved, then we have to see that whether it is probable or not. More than 50% chances are there, together with the other conditions to be fulfilled, again, it's a provision. Again, we are going to recognize it as a liability. Got it? Chances are lesser than 50% than other criteria. Now, simply, if any of these criteria is not being met, a certain event will not be recognized as a provision, but a contingent liability. A contingent liability. Say, for example, here, we are going to replace this word probable with possible. Possible means chances are lesser than 50%. It will be now known as a contingent liability. A contingent liability is never shown on the face of the financial statements. It will be disclosed in the notes to the financial statements. Okay, we are going to learn about the contingent liabilities as well. But after here, you must be knowing that if any of the criteria is not being met, there is a contingent liability and it will be disclosed. Disclosure means it will be highlighted in the notes to the financial statements. It will not be written on the face of the financial statements. When the provision is going to be recognized, what accounting entry we have to pass? Debit expense, credit provisions. It means that expenses are being increased. We have to record this in our statement of profit or loss. And on the other hand, liabilities are also increased. That is why we are giving credit. We have to write it in the statement of financial position. So two effects will be there for provisions. One in the statement of profit or loss, other in the statement of financial position. Debit expenses, credit provisions. Now, my dear students, in future, if the organization comes to know that provision which they have recorded is of lesser amount, it has to be increased. When the provision has to be increased, the same accounting entry is going to be passed. Got it? Same accounting entry is going to be passed. In statement of financial position, only increase in provision is going to be recorded. And in statement of profit or loss, only increase in provision is going to be recorded, only the expense which we are going to increase. In statement of financial position, the total amount of provision which will be present at the year end is going to be recorded. Same what we do in the case of depreciation. Same we do in the case of any kind of liability. Okay. So in the statement of profit or loss, only the movement is going to be recorded. In the allowances also, we have done the same thing. Allowances for receivables. When they are going to be increased, the increase in allowances will be recorded in the SOPL. But the total amount closing balance on the allowances for receivables will be recorded in SOF. Same we are going to repeat in the case of provisions as well. When this is going to be increased, same accounting entry. When it is going to be decreased, reverse accounting entry. Debit provisions, credit expenses. They say the provision will need to be classified as either the current or non-current liability as befits the situation. The provision can be a current liability if it is probable that it is going to be, it is going to be resulting within 12 months. If more than 12 months, it is a non-current liability. So it can be a current or non-current liability as per the situation. Mariam, are you clear?
Yes, ma'am. I want to ask about the reliable estimate. Is it means faithful representation?
Sorry, what does it mean?
Reliable estimate. Is it same like faithful representation?
No. Reliable estimate means that there are some documents which are giving us the evidence of the amount of that particular liability.
Okay, ma'am.
Okay. Now, students, illustration number 1, the requirement of the question is, should an obligation be recognized at 31st December 2007 for either of these lawsuits? Okay, 31st December 2007 is the year ending date. So your starting date is 1st January 2007. If an event under consideration has occurred in between these two dates, it can be recognized as a provision. What is the definition of provision? It is a liability of uncertain timing and amount. What is the 3-point criteria? Number 1, a present obligation arising from the past event. It is probable that the economic benefits are going to be outflowed as a result of that liability, and the third one, a reliable estimate can be made. If these three criteria are going to be met, then you have to record an obligation as the provision in your books of accounts. If, say, for example, something has occurred after this year ending date, it is not your current year liability then. It is not your present obligation. Present obligation means it must be present before to year end. Let's read the scenario. The criteria referred to above mean that the provision can only be recognized in an accounting period if recognition of liability has been triggered at the year end. For example, Smith Company's year end is 31st December 2007. Is this solution? No. Question it is. Okay, Smith Company's year end is 31st December 2007. In November 2007, before the year ending date, in November 2007, Smith Company dismissed an employee. In February 2008, a customer slipped whilst on Smith Company premises and broke her arm. One event has been occurring before to the year ending date. The second event has occurred after the year ending date, 1st February 2008. In March 2008, both the employee and injured customer sued Smith Company, the previous one, for unfair dismissal, and the latter for compensation for injuries suffered on Smith Company's premises. Now, my dear students, the year ending date has been 31st December 2007. One event has occurred in November 2007, and the other event has occurred in February 2008. Both the customers has sued the organization in March 2008. Now, you have to consider that whether the event has occurred before the year ending date or not. Event, it is not about the case. The event for which the case has been made, how it has occurred, at which date it has occurred. So one event has been occurred before to the year ending date. For that particular event, if the certain criteria is being met, it will be recognized as a provision in our financial statements of 31st December 2007. For the next event, next year we are going to see. Got it? So what are we going to do? We are going to recognize the provision for the first event since it has occurred before to the year ending date. Present obligation arising from the past event. But for the second event, we are going to see in the next year. If the criteria is going to be fulfilled, then we are going to record it as a provision, otherwise not. Now here in this scenario, you can see that this is an incomplete type of a scenario. They have, they have made this scenario only on the basis of one criteria, that is the present obligation arising from the past event. So you must be clear that if the event has occurred, I'm telling you again and again, this type of questions can come in exam where you are going to be confused. Do not see as per the lawsuit. See the event. If the event has occurred before to the year ending date, then you are going to see the other criteria, whether it is being met or not. Okay. So for this case, in November 2007, the event has been occurred. For that, you can recognize the provision. But for February 2008, the event which has occurred, you are not going to recognize the provision in this current year. Clear, everyone? These type of questions just come in the exam where simply you become confused. Okay, now students, they are telling us about the definition of contingent liability. I have told you that if any of the criteria regarding provision is not going to be met, it means that it is a contingent liability. Standard is telling us these definitions regarding contingent liabilities. They say a contingent liability is defined as a possible obligation. Possible obligation means chances are lesser than 50%. It is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of an entity. There are certain events of the organization in which their outflow, the outflow of the economic benefits is dependent upon one or more future uncertain events. Say, for example, if something in the future is going to occur, then the economic benefits are going to be outflowed. It is known as a contingent liability. Contingent means dependent upon some future event. Say, for example, your mom says that if tomorrow the weather is going to be good one, we will go outside for the outing. It means that it is contingent, it is dependent upon the weather now. So contingent liability is a possible obligation when the chances are lesser than 50%. And its occurrence is dependent upon the occurrence of some future uncertain event, which is not in the control of the organization. That will be the contingent liability. Whenever the criteria for the contingent liability is fulfilled, you are going to disclose it in your statement of, in your notes to the statement of, in your notes to the financial statements. It will never be recognized in your financial statements. The second definition, a present obligation that arises from the past events. This is what we have seen in the case of provision as well. But it is not recognized because it is not probable. Not probable means it's not possible. And not probable means that one of the conditions of provisions is not being fulfilled. It is not probable that an outflow of the resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. It means that the first criteria of the provision is being met, second and third criteria is not being met. What is the second criteria? It is probable. Here it is not probable. What is the third criteria? Reliable estimate can be made. Here the estimate cannot be made. So we can say that if any of the criteria regarding provision is not being met, it is a contingent liability. For contingent liability, there is no accounting entry because we do not recognize it on the statement of financial position. What is a contingent asset? Same like contingent liability, contingent asset will result in the inflow of the economic benefits. But again, it is dependent upon the future occurrences of some events which are not under the control of the organization. So contingent assets, same like contingent liabilities, are not going to be recognized on the face of the statement of financial position. For contingent asset, if it is probable, for contingent liability, the word is possible. For contingent asset, if it is probable that the asset can arise, then we will disclose it. We will disclose it in the notes to the financial statements. When the chances are more than 50% that an asset can result and the inflow of the economic benefits are going to result because of that asset, if it is probable, then we are going to disclose it. Again, prudence concept. The degree is higher than the contingent liability. But for contingent liability, even if it is possible, you are going to get the disclosure in the notes to the financial statements. In the case of contingent assets, if it's possible, no treatment, not disclosure, no recognition. If it is probable, then disclose it. When in the case of liability, if it is probable, recognize it. For contingent asset, if it is probable, disclose it only. If it's possible, ignore it. No disclosure, no recognition. Getting the point? So contingent asset is defined as a possible asset. A possible asset that arises from the past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of an entity. So what is the difference between contingent asset and contingent liabilities definition? Only that it is an asset and that one is the liability. Contingent liability is the which word we have used in the case of contingent liability? Sorry? No. Possible. Okay? In the case of if it is probable, then it's provision. Okay? In the case of contingent asset, it's possible asset. Okay?
Ma'am?
Yes, dear.
Can you please explain the contingent asset because I don't understand.
Contingent, it's contingent asset. It's the same as contingent liability. It will be dependent upon one or more future events And when they are going to result, it will result in the inflow of the economic benefits. Okay, that is a contingent asset. It's a possible asset. Students, here we are summarizing the facts. Okay, probability of the occurrence. If the probability of the occurrence is there, it's virtually certain. What is the meaning of virtually certain, students? See here, more than 95% chances are there. If it's virtually certain, contingent liabilities provide. Contingent assets recognize. Provide and recognize means that record them on the face of the balance sheet, statement of financial position. Okay, contingent liabilities here will become provisions. When it is virtually certain, actual liability it will become. Okay, so we have to recognize it. Contingent assets are also going to be recognized when the chances are more than 95%. When it is probable, probable means chances are more than 50%. It means that 50% itself is not included. 51% to 95%. If it is probable, provide. Liability is going to be provided. It is going to be recognized on the face of the SOFP. For contingent assets, if it is probable, only disclose it. Okay. If it's possible, for contingent liabilities, possible means 5% to 50% chances are there. For contingent liabilities, disclose in the notes to the financial statements. Contingent assets, ignore. Okay, contingent asset is going to be ignored. For contingent liabilities, if it's possible, you have to disclose it in the notes to the financial statements. And if it's remote, remote means chances are lesser than 5%. Then ignore contingent liabilities, ignore contingent assets. So we summarize the facts again. If the chances are more than 50% and more than 95%, the actual liability is going to be arising regarding provision and actual liability. More than 95% means virtually certain liability. Liability has to be recognized. More than 50%, 51% to 95% chances are there. It's a probable event. It's a provision. Expenses, debit, provisions, credit. It has to be recorded on the face of the SOFP. If the chances are possible, it means that the chances are between 5% to 50%. 50 itself is going to be included. It means that it is a possible contingent liability. It has to be disclosed in the notes to the financial statements. If it's remote, lesser than 5% chances are there, ignore it. Come to the contingent liability now. Contingent liability is the possible event. If the chances are 5% to 50%, disclose it in the notes to the financial statements. Come to the contingent assets. Contingent asset is the possible asset. If the chances are between 5% to 50%, ignore it. If it's probable, then record it as the contingent, disclose it as the contingent asset in the notes to the financial statement. Got it? So see the degree. For liabilities, if it's probable, you have to record it. If for contingent assets it's probable, only disclose it. So it means that we are more prudent in the case of liabilities as compared to the assets. Okay? Assets have only to be recognized only when they are virtually certain, more than 95% chances are there. Even if they are probable, we are not going to record them, we are going to provide them. Virtually certain means more than 95%, probable means 51% to 95%, possible means 5 to 50%, remote means lesser than 5%. This is not the dictionary meaning. They have just concluded it for the purposes of accounting. Now, understanding number 1 is there, students. State with reasons what adjustments, if any, should be made by Madras in the financial statements. Mariam, are you cleared up till here?
Yes, ma'am.
Okay. The draft financial statements of Madras, an entity for the year ended 31st December 2006, are currently under review. The following points have been raised. My dear students, what is the year ending date? Year ending date is 31st December 2006. Year starting date is 1st January 2006. Okay? An ex-employee has started an action against Madras for wrongful dismissal. The entity's legal team has stated that the ex-employee is not likely to succeed. The entity's legal team has stated that ex-employee is not likely to succeed. The following estimates have been given by the lawyers relating to the case. Legal cost to be incurred whether the claim is successful or not, 5,000. This is must to occur, even if the case is going to succeed or not. What does that mean? That it is virtually certain. It means that the chances are more than 95%. What do we have to do? Provide for. Settlement of the claim, if successful, $15,000. Currently, no provision has been made by Madras in the financial statements. Now, they are giving us the term, the ex-employee is not likely to succeed. If, say, for example, you consider that the chances for this claim to occur are more than 50%, that it will occur, you are going to provide for it. If you feel that the chances for this event are lesser than 50%, you are going to disclose it as the contingent liability. If you feel that chances for this to occur are lesser than 5%, ignore it. Okay? In the exam, they will be using the terms of probable, possible. Over here, they are just telling you it is not likely to succeed. It can be remote, it can be possible, or it can be probable. So in this question, they are just asking for the discussion. If the chances for this event to occur are more than 50%, provide for it. If lesser than 50%, disclose it. But this one, legal cost, is your liability. You have to record it right now. Legal cost to be incurred whether the claim is successful or not. Provision is going to be recorded for it. Debit expenses, credit, provision. Second case, Madras has policy of refunding the cost of any goods returned by the dissatisfied customers. Now, policy of refunding, what does that mean? That it is the legal event. Legal obligation is there. Past event is the legal event because it has the policy. Madras has the policy of refunding the cost of any goods returned by dissatisfied customers, even though it is under no legal obligation. No legal obligation means that it is a constructive obligation now. When they are telling you that there is no legal obligation for that, it means that it is a constructive obligation. Both are obligations, legal or constructive. Although it is under no legal obligation to do so. The policy of making refunds is generally known. Others are now expecting from the Madras company that whenever they are going to return goods, a refund will be made. Constructive obligation. At the year end, Madras reliably estimated that returns totally 4,800 will be made after the year end. Now, what does that mean? That the conditions regarding provision are being fulfilled. A past event, a present obligation arising from the past event. Past event is the constructive obligation. And Madras reliably estimated, it's a reliable estimate which has been made, that returns totaling 4,800 will be made after the year end. After the year end, it has to occur. It means it is the current liability. The expenses, debit, 4,800, credit, provision, 4,800. They have not given us any data regarding probability of the event. So because they have not given us the remaining criteria is being met, we are going to recognize provision. Okay. Third case, a customer has made a claim against Madras for injury suffered following the purchase and use of defective product. Event has occurred. Legal advisors have confirmed that Madras will probably have to pay financial compensation of 100,000 to customer. Up till now, what is the criteria telling you? Provide. Very good. Chances are more than 50% probable event. Okay, which will result in the outflow of economic benefits. But let's see the other. In return, Madras has made a counterclaim. Okay, now Madras has also made a counterclaim. Counterclaim against the supplier of the defective product for 100,000 and believes it is probable that it claims against the supplier will be successful. Now, here is the probability of liability. This is the probability of asset. For probability of the liability, what is the condition? If chances are more than 50%, recognize it. Debit expenses, credit, provision. What is the amount? 100,000. And the condition regarding probable asset, if it is probable, disclose it. No accounting entry, just disclose it in the notes to the financial statements. Got it? So one side it will be recognizing the provision for liability. On the other hand, it will be giving the disclosure regarding contingent assets. Got it now? See over here, if the asset is probable, disclose it in the notes to the financial statements. Yes, is everyone cleared?
Yes, ma'am. Yes, ma'am.
Okay, now students, they are telling us about the movements in provision, as I have told you already. Whenever there is an increase in provision, repeat the same accounting entry. Debit expenses, credit provisions. When there is a decrease in provisions, reverse that accounting entry. Debit, provisions, credit, expenses. So movements in provisions should be reviewed at each statement of financial position date. Statement of financial position date is year ending date and adjusted to reflect the current best estimate. Increase in provision, relevant expense account, credit provision, decrease in provision, debit provision, credit, relevant expense account. Okay, reporting. Now this is the end of the chapter. Now we have to discuss about the disclosure requirements. For every international accounting standard, there are 3 points which you have to discuss: recognition, de-recognition, and disclosure. When are we going to recognize? When we are going to de-recognize, what we have to disclose. In the notes to the financial statements, the details of everything which you are recording on the face of the financial statements has to be given. So regarding the disclosure of provisions or contingent assets or contingent liabilities, what you have to do? Reporting provisions in the financial statements. Final accounts. Provisions have to be reported in the final accounts. Final accounts are financial statements. Provisions are reported as liability in the statement of financial position. Provisions may be classed as either a current or non-current liabilities depending upon the subject matter of provision. What have to be disclosed? According to IS 37, the following are the key disclosure requirements relating to provisions, contingent liabilities, and contingent assets. When the requirement is to provide for the contingent liability, the liability is reflected in the financial statements, but called a provision in order to highlight the uncertainty surrounding it. The movement in this provision is recorded in the financial statements each year. The movement is when increase in provision, do record the increase in SOPL and the total year-ending provision in your SOFP. When disclosure is made by note, the note should state the nature of contingency, the uncertain factors that may affect the future outcome, the estimate of the financial effect, or statement that such an estimate cannot be made. If you are not able to make a reliable estimate, then you have to show the evidence regarding that what are the factors on the basis of which you are not able to make an estimate. With this, we have finished this chapter, students. Now, the next chapter which we are going to start is capital structure and finance cost. Very easy chapter, again, a small, not that small, but still summarized chapter, okay? Capital structure and finance cost. We do know that in the public limited entities, we do have the capacity to issue the shares to the general public. Whenever the limited liability companies are formed, basically they are of two types: private limited liability companies and public limited liability companies. Public liability limited companies, PLCs, have the capacity to issue the shares to the general public in order to get the capital. On the other hand, they do have the capacity to issue the loan notes to the general public in order to get the capital. They can take the loan from the financial institutions as well, which is going to be resulting as the capital for their organization. So majorly, there are two sources of finance, two sources of capital for the limited liability companies: debt and equity. That is the capital structure and finance for the limited liability companies. Debt and equity. Either they can issue the shares to the general public, or they can get the finance by taking loan, by issuing loan notes, or just by taking the loans from the financial institutions. In this chapter, we are going to learn about the total capital which is generated by the limited liability companies. What is capital used by the company to generate wealth? It is debt or equity. Under equity, we are going to learn about the different types of the equity. We are going to learn about the concept of share capital and other reserves. Maybe some of you do have the confusion in your mind that capital is only the share capital. Capital is the amount which is coming in the organization by the shareholders. No. Capital includes all of the amount which is available to the company in order to run its operations. It can either be raised by issuing the shares to the general public, or it can be raised by taking the loans from the others also. So capital is the finance which is used by the organization in its premises in order to run the operations and in order to generate wealth for the shareholders. So debt and equity are two forms of the capital for the organization. Under capital, share capital is the one which is coming from the equity investors. As I told you that there are two broad sources of finance for the organization. Either the organization can raise its finance by having the debt, by collecting the debt, or it can raise its finance by issuing the shares to the general public. So two sources of finance for any limited liability company are debt and equity. Now, my dear students, you need to learn the difference between debt and equity. Debt is a loan. Debt is a liability, responsibility, and obligation of an organization. What are the basic features of a debt? When any person or any organization takes a debt, there are some mandatory repayments involved with that. Whenever someone or some organization is taking a debt, it's a promise that the principal amount which is taken as the debt is going to be repaid at some future date. On the other hand, there is some return which is promised with the amount of the debt. That amount of return which is attached to the debt is known as interest. Interest is also mandatory to be paid. This is cost of servicing the debt, cost of using the debt finance. So what are the characteristics of the debt? Whenever the debt is taken, the principal amount is promised to be paid back at some future date. What is the second quality or characteristic of the debt? That interest has to be paid at the proper particular intervals. On the other hand, what are the characteristics of equity? When some persons do take the shares of the company, at the time of issuing the shares, company never promises that the amount of the shares which has been collected by the company will be repaid at some future date. Share amount is never promised to be paid back to the shareholders. Together with that, the amount of dividends which is paid as the return for shares is also never promised to be paid. Got it? For equity holders, there is no promise for the principal amount and no promise for the dividends to be paid. For debt providers, it is mandatory that principal amount is going to be paid and the interest amount which is promised with that debt is also going to be paid. Got it? Now, in accountancy, one concept which we follow is substance over form. Do you remember that concept? Substance means economic substance, form means legal form. We are responsible in financial accounting that when legal form of anything is coinciding with its economic substance, we are going to give the priority to the economic substance. If, say, for example, you are encountered with something which is having the characteristics of debt in it, but it is named as equity, you are going to recognize that thing as the debt. Its legal form is that of the equity, but because its characteristics are that of the debt, that is why you have to recognize it as the debt. Say, for example, one kind of the shares are preference shares. Preference shares are of two types: redeemable preference shares and irredeemable preference shares. Redeemable preference shares are the ones with which, when they are being issued by the company, it is promised that the principal amount is going to be paid and the dividend is also promised to be paid by the company. That is why we do not recognize the preference shares as equity financing, but we recognize them as the debt financing. Redeemable preference shares. On the other hand, irredeemable preference shares, principal amount is not promised to be paid, dividend amount is not promised to be paid, we recognize them as equity. So what I mean to say that some types of the capital which are obtained by the company are debt, some are equity, and some are both debt and equity. Like I have given you an example of preference shares. Irredeemable preference shares are equity, very good. Redeemable preference shares are debt. So in your exam questions, you will be checked about that. This is the repetitive question in the exam. They are going to ask you, irredeemable preference shares are equity and redeemable preference shares are debt. Okay, this is the concept of substance over form, which is going to be followed. So regarding debt, what they say, holder of the debt is entitled to some form of mandatory repayment. That is interest and repayment of the capital. Equity holder is not entitled to any repayment. Instead, they share the residual assets of the business when it ceases to trade. Now, they are trying to give you the detail of everything, my dear students. Although in the exam, you will not be tested in that detail. Residual assets means the excess of assets to the liabilities. This is the residual interest. And just go back to the accounting equation. What is an accounting equation? Assets minus liabilities is equal to equity. If nothing is promised to the equity holders, why would they be trusted to give the capital in the company? The principal amount is not promised to be paid back, and the amount of dividend is also not promised. It is on the will of the directors. Then why would they be trusted to, to be attracted to be investing in the company? Because of this residual interest. When the company is going to be winded up, whatever is remaining in the organization is belonging to the equity holders. All the reserves, retained earnings, revaluation surplus, share premium belongs to the equity investors. So that is why equity holder is not entitled to any repayment. The amount of shares no repayment. The amount of dividend, no repayment. Instead, they share the residual assets of the business when it ceases to trade. Clear everyone about this one? Students, the reason why I'm teaching in detail, because these concepts will be helpful in the future ACC exams as well. Okay, from time to time, these concepts are going to be revised. You will see. Now, my dear students, here they are explaining different types of the finances or capital in the organization. The first one is ordinary share capital. Whenever we are normally taking the name of share capital, it means that we are speaking about ordinary share capital or equity share capital. Ordinary share capital is the one which is raised by the actual shareholders and owners of the company. Who are the actual owners of the company? On ordinary shareholders. Ordinary share capital is the type of the capital which is not going to have any priority towards any of the repayments from the company. When the organization is running, the amount of share which is promised to them, which is not promised to them, is not going to be paid. The amount of dividend is not promised to them to be paid. In the event of company being seized, when the amounts have to be repaid to the different investors, to the different debt providers, ordinary share providers just come on the last. But why are they interested to invest in the company? Because whatever is left over in the company belongs to them. So ordinary share capital is the first form of the capital. This is equity, as the directors are under no obligation. See, no obligation to repay the investors, shareholders, or to pay them a dividend. Do not ever consider that dividend is going to be paid on the will of the shareholders. It is on the will of the directors of the company. An ordinary shareholding is evidence of the ownership of the company, and the shareholders receive the residual interest in the business once it ceases to trade in proportion to the size of their shareholdings. Ordinary shares are shown under equity on the SOFP. Where do we show the ordinary share capital? Under the head of equity. In SOFP, assets, and then we do show liabilities and equity. Under the head of equity, the first thing which is being shown is ordinary share capital. They are the true owners of the company. Directors may choose to pay the shareholders an annual dividend. So who is on whose wish the dividend is dependent? Directors. Directors may choose to pay the shareholders an annual dividend. These are recognized in the statement of changes in equity, not in the statement of profit or loss. This is not the deduction from profit, it is the distribution of profit to the rightful owners of it. Here they are explaining the true positions of different things which are going to arise in the case of ordinary share capital. Ordinary share capital is being shown under the head of equity, and in statement of changes in equity also we do show ordinary share capital. The dividend which is going to be paid to the ordinary share capital providers will only be shown under the head of statement of changes in equity in your statement of changes in equity. It is never going to be shown in SOFP or in statement of profit or loss. Dividend will be shown only in the statement of changes in equity. In SOPL, not an ordinary share capital, not dividend. Nothing is going to be shown. Got it? But interest is going to be shown in SOPL. Interest which is being paid to the loan providers will be shown in the SOP. Dividend is not going to be shown. Clear? Now the second type of the finance which is available to the company's loan notes. In the case of ordinary shares, it is being issued by the company. Companies do issue loan notes as well. Like you purchase the bonds from the market. Sometimes you can discuss it with your parents. They might be having the bonds of the different countries, or say for example from the companies itself, they have purchased the loan notes as well. Loan note is is a paper. Okay, it's kind of a paper on which the conditions regarding the loan are written. That this is the amount of the loan which you have provided to the certain company, and this amount of interest will be paid to you every month or quarterly or semi-annually or annually. So loan note is an evidence which shows that the particular person has given the loan to the company. Loan note, under the terms of loan note agreements, directors are usually required to pay the loan holder an annual interest amount and are obliged to repay the full debt, at the fixed point in time. So this is contrary to the characteristics of the ordinary share capital. The amount of the principal is that has to be paid at a certain future date, and the amount of interest is also mandatory to be paid. This is therefore a form of debt and appears as the liability on the SOF. Now, where do we show the loan notes? Under the head of liabilities. We show loan notes. Regarding loan notes, the interest which we have to pay will be shown in the SOF. Got it? Any unpaid interest at the year end, that is accrued interest, will also be shown under the head of liabilities. If any interest is not being paid by the company at the year end. In the SOCIE, no interest, no loan. Got it? The interest payment is treated as the finance charge, which is shown as an expense in the statement of profit or loss. Just give me a while, students. Good morning. वालेकुम अस्सलाम, अल्हम्दुलिल्लाह मैं ठीक ठाक। Students, actually today is an event which has been conducted by BTech students, which is also coming under CEC. So they want me to take all of you over there in that event. So do you want to go now or after the break? You don't want to go? Why? They are actually feeling for you that you should not be feeling isolated. Let's see what they do over there. Let's meet. Don't you want to meet them? For my online students, we cannot do anything for you.
No, ma'am.
No? Okay. So we can just go for 15 to 20 minutes or 30 minutes over there. Okay. After that, we are going to restart. Okay, my online students, then we are going to rejoin after 30 to 35 minutes or maybe 40 minutes.
Okay, ma'am. Okay, ma'am. Sure. Enjoy.
Okay, ma'am.
Including break. Okay. Okay. Then see you after the break.